Stock indices are created to provide a picture of how the average stock in that index is performing. The idea is that if you have a large portfolio, the index can reflect the changes in your wealth that day. For example, Dow Jones Industrial Average tracks large cap stocks, companies like Disney. So we're going to talk about how indexes are calculated and then what stocks are actually in those indexes. First, we have what's referred to as price-weighted indexes. So essentially, we can do an average of the stock price, the average of the stock prices. Again, in this case, we have a three-stock index for 2 days. So we can see here that there were 100 million shares, 20 million, and 1 million shares. So the total capitalization is, in this case, it's 5,000 million, or $50 times 100 million. So here's the capitalization for each of the companies. The price today, $50, $30, and 100. So the average price each day was 60. The average price that was yesterday. Today, the average price $49, 31, $1.03. That price then is now $61 is the average for the day. So this index average rose from 60 to 61. So again, if you take the prices and if you divide it by the number of shares or stocks, not shares, in separate stocks, you get the average. So 50 plus 30 plus 100, divide that by 3 is 60. And of course, 61 divided by 60 gives us this 1.67% change during the day. Now, there is a challenge when something like a stock split, where if a company leaves the index, that does create challenges for consistency with understanding what's going on with the values of the stocks in the index. So we could do an average of those stock prices as we did before, but in this case, we need to add a divisor or a denominator. Now, this is the mechanism that's going to allow us to adjust for things like stock splits or if companies leave, right? So this number changes if one of these major occurrences happens. So we can do an average of the stock prices again. Let's say this company at the bottom does a 2-for-1 split. So the value changes. So on this day, you see that we have that original value. You just say 50 plus 30 plus, divide by 3, 60. But now, because there was a stock split in miniature, the price changed. So now the prices the next day are 49.31 and 51.50. So now when you do this average, if we use an average, it's not going to be the same. It's not going to mean we won't be able to relate this 43 to that 60 because things have changed inside the index. So how do we do this? We need to solve for that divisor, right? Before the change, right, we knew that the value was $61. So how can we make this new index? 49 was the same price, 31, but this is the new price, 51.50. We need to solve for x. What x will give us the 61? So in this case, each index that we look at, they all have these divisors that will help us make the numbers consistent across time. Now, a value-weighted index is slightly different. This tracks total capitalization of the companies. So again, we start with our same companies, same prices. Now, what is the capitalization each day? We knew that. So the total capitalization on the first day here is $5,700. But now the next day, prices changed. When these prices changed, total capitalization changed. So now we find the difference. It went from 56 2023, right? It was 5,700. Okay, multiply that by 100 gives us an index value today of 98.65. And it's less than 100, so that tells us that the index is going down. So how can we make comparisons of these indexes? Again, value-weighted index calculations, they don't change based on stock splits or things like that. They really don't change that much. It's impacted more by when stock prices change in the companies that have the largest capitalization. Now, price-weighted is impacted much more by stock price changes themselves, especially companies with large stock prices. So let's look at some major stock indexes. Here's the Dow Jones Industrial Average, and here is the list, according to our book, of what companies are in there. Now, what I will tell you is that over time, things change. So from this list, the current list, the companies that have left the Dow are the Dow Jones Industrial Average is Dow, the chemical company, is now gone, Intel is gone, and Walgreens is gone. So what replaced those companies? Amazon, NVIDIA, and Sherwin-Williams are now in that index. And of course, it's a price-weighted index. So again, the idea is it's supposed to help us relate to large stock price changes. What about the S&P 500? Well, again, this tracks the 500 most important companies in 11 industries from any exchange. It includes all, of course, the Dow Jones Industrial Average. So the current distribution here is the right, and you can see that 27% comes from information technology. 13% healthcare, 12.3% consumer discretionary, 11% is financials, 11% communications. And then we have these smaller divisions. So most of the value that we see changing in the S&P 500 relates to these major indexes or major sectors that are represented. What about the NASDAQ? The NASDAQ includes about 2,500 companies that trade, including some foreign companies. It's a value-weighted index that's largely focused on technology, as those stocks are, again, the largest component of this index. So other indexes can be focused on things like market segments. So here we have something called the Wilshire Equity Indexes. They're only U.S. companies. So the Wilshire U.S. Large Cap Index is the top 85th percentile by capitalization. That means it has 85% of all the stocks in the U.S. market are there. The mid cap takes 70 to 85, and the Wilshire obviously is those things that are less than percentile. And what you can see is how the markets go. They certainly seem to go, the mid cap and the small cap seem to follow each other directly, but the large cap seems to run a little bit slower, a little bit smoother. Well, you think it has a lot more stocks in it, so it is going to run a little bit smoother over time because of averaging. So these indexes are much broader measures, right? We have, even as you can see here, we can break stocks down into different sized markets, mid cap and small cap. The Russell indexes include only common stocks of the United States. So we have the Russell 3000. It's the largest 3,000 U.S. companies. The Russell 2000 index, that's the smallest of the 3,000. So again, all 3,000 are here. The 2,000 is just it does not include the top 1,000 valued company. So again, it is a smaller value company. So the Wilshire Value and Growth Indexes also can look at large cap value indexes and large cap growth indexes. We can also look at different parts of market segments themselves. We can look at the S&P 500 Healthcare Index. There are foreign stock indexes, the Nikkei, the FTSE, the Canadian TSE 5. There are also some global kinds of indexes. We can look at Europe, Australasia. EAFE is the Far East index. So there are also volatility indexes. These things measure investors' expectations about market volatility. So all of these indexes, the purpose of all these indexes is to give us a very short picture of how our particular portfolios and our individual wealth may have changed. So if you have a very large stock portfolio, right, you may want to use the Dow Jones or the S&P 500 to represent your particular investment strategy. Again, so we'll move on and talk about other types of stocks and how they're all related to indexes in later videos. Look forward to talk to you soon.